Welcome to the Explainer. I am absolutely thrilled to have you here today. We're going to decode the Finance Bill 2026, and we're going to do it completely free of any confusing legal jargon. Legislation like this can often feel like a giant maze, but our goal today is to give you a clear, structured breakdown. We're stripping away the dense text and pulling out the exact data points you need to know to adapt, prepare, and thrive. So here is the million-dollar question. Literally, for some of you, how will the Finance Bill 2026 reshape your company's bottom line? Whether you're running a traditional manufacturing plant, a digital services startup, or managing corporate compliance for a massive firm, this legislation is absolutely going to shift the ground beneath your feet. In this explainer, we're going to translate these dense new legislative rules into actionable business intelligence so you can get ahead of the curve. Here's a quick roadmap of what we're covering today. 1. Filing deadlines and compliance. 2. VAT exemptions and adjustments. 3. Telecom and digital taxes. 4. Sector tax burdens compared. 5. War and clothing import duties. And finally, 6. Tax planning risks. Let's jump right in. Okay, let's dive into this. Section 1. Filing deadlines and compliance. These overarching compliance updates affect absolutely every single business operating in the market. The timeline you are used to for settling your accounts, it's fundamentally changing. The magic number is now 4. Historically, businesses often had up to the last day of the 6th month following the end of their year of income to file their tax returns. Well, the Finance Bill 2026 aggressively tightens that window. Tax returns are now due by the last day of the 4th month. That means your finance and accounting teams are going to have to close the books and audit their figures significantly faster. And actually, if your business is filing a nil return, meaning there's no tax payable for that period, the runway is even shorter. You now only have a highly accelerated 1-month window following the end of the year of income to file that nil return. The crucial takeaway here is that the Revenue Authority wants absolute visibility into dormant or non-taxable entities immediately upon the year closing. No more waiting around. Let's move on to Section 2, VAT Exemptions and Adjustments. Time for some potential cost-saving opportunities. If your supply chain touches any of these newly VAT-exempt items, you're looking at some immediate relief. The legislation exempts critical healthcare items like human blood and dialyzers, but it also heavily favors local manufacturing and agriculture. Inputs for animal feeds, pharmaceutical inputs, and even sugarcane transportation from farms to milling factories are all now exempt. Public-private partnership infrastructure goods get a nod too. But here's the catch. What happens if you currently hold stock of these items that you previously paid VAT on? Now, what's really interesting about this brand new Section 17A procedure is the strict clawback mechanism. If your taxable stock suddenly becomes exempt overnight, you can't just keep the input tax deduction you already claimed. Nope. You must identify that unsold stock, calculate the input tax related to it using your original method, and essentially reverse it by paying any excess input tax back to the commissioner in that period's return. It is a strict rule you absolutely must account for during this transition. All right, Section 3, Telecom and Digital Taxes. While agriculture and local manufacturing are seeing some nice exemptions, the government is introducing some very stringent new revenue measures for the digital economy. The bill massively expands the legal definition of a royalty. It's no longer just about music or patent rights. A royalty now officially includes payments made to use off-the-shelf software, proprietary digital platforms, and crucially, payment networks and clearing systems. Think about that for a second. If your business pays a periodic or transaction-based fee to access a payment card scheme or a software-as-a-service platform, those payments might now be caught straight in the withholding tax net as royalties. And this brilliantly illustrates the heavy new burden being placed on hardware. There's a stark 25% excise duty now levied on the excisable value of both imported and locally purchased telephones for cellular networks. This is a massive cost increase, and for sure, it's going to ripple right through the consumer electronics market and hit any businesses relying on widespread mobile device deployment. But honestly, the tax rate itself isn't even the most fascinating part of this. It's the enforcement mechanism. The liability for this excise duty doesn't just trigger at the port of import or even at the point of sale. The law now explicitly states that liability arises at the exact time of the phone's activation. This is a highly technological approach to taxation. It's likely designed to curb gray market smuggling by tying the tax directly to the exact moment the device connects to a local cellular network. Incredible, right? Let's zoom out a bit for Section 4, Sector Tax Burdens Compared. Stepping back to compare the distinct economic realities shaped by this bill, the divergence between agriculture and electronics is super sharp. The agricultural supply chain is clearly being incentivized. Removing that on animal feed inputs and sugarcane transport lowers the barrier to domestic food production. Conversely, the electronic goods sector is being utilized as a heavy revenue driver, burdened with that 25% excise duty strictly enforced via network activation. We see the exact same pattern playing out right here. Traditional, physical manufacturing, especially in critical sectors like pharmaceuticals, is being shielded with raw material tax exemptions. Meanwhile, the modern digital services sector faces a rapidly widening tax net. By redefining standard software and payment processing fees as royalties, cross-border digital service operations are going to face much heavier compliance and withholding tax complexities. Moving on to Section 5, Worn Clothing Import Duties. Now, this is a highly specific but economically massive niche, and it is undergoing a complete compliance overhaul. The government is introducing a presumptive tax model here. If you look at how this breaks down, the taxable profit for importing worn clothing is now legally deemed to be exactly 5% of the customs value, so no more complex deductions or profit arguments at the border. Furthermore, this tax is due upon importation and must be paid prior to the release of the goods. While the domestic sale of these items remains VAT exempt, the border entry is now a tightly controlled revenue checkpoint. Finally, let's look at Section 6, Tax Planning Risks. For our final focus today, every CFO needs to navigate these strict new anti-avoidance measures extremely carefully. This specific provision is arguably the most powerful new tool in the Revenue Authority's arsenal. Under the new Section 18A, if the commissioner determines that a business entered into a scheme or arrangement where the primary purpose was just to gain a tax benefit, like, say, artificially accelerating an input tax deduction or delaying a tax payment, they now have the power to completely void it. They can calculate your tax liability as if your carefully planned corporate arrangement never even existed. And the risk window for this is incredibly long. If you execute a tax planning strategy today, the commissioner has up to 5 years from the end of the tax period to audit, void the scheme, and issue a new assessment. This literally means that aggressive tax planning will carry a half-decade shadow of potential financial liability right on your balance sheet. Another major risk area to keep an eye on is the virtual asset and cryptocurrency space. The bill officially defines virtual asset service providers, or VASPs. If your entity handles virtual asset transactions, effectuates exchanges, or operates a trading platform, you are now legally bound to file comprehensive annual information returns detailing the activities of your users. The anonymity of crypto? Yeah, that's effectively being legislated away for compliant businesses. And listen to this. The financial penalties for VSPs failing to adhere to these new transparency laws are severe. Failing to file the information return or even a nil return results in a massive 1 million shilling penalty per failure. Making a false statement or simply omitting required information will cost you 100,000 shillings per instance. Proactive compliance and flawless record-keeping are absolutely no longer optional in the virtual asset space. All of this data collection, from digital payments to crypto providers to strict electronic invoicing, it all leads to this point. The Finance Bill grants the Commissioner the power to use their electronic systems to generate pre-populated tax returns on behalf of taxpayers. Basically, the Revenue Authority already knows what you owe before you even sit down to calculate it. The technological gap between businesses and the taxman is closing fast. Which leaves us with one final vital thought to ponder. With accelerated filing deadlines, real-time taxes on device activations, strict anti-avoidance lookbacks, and pre-populated tax returns based on massive data harvesting, are your current business operations agile enough to comply with these rigorous new tax mandates by 2027? It is definitely time to start your tax planning and system upgrades immediately. Thank you so much for joining me for this explainer. Keep learning, stay structured, and we'll see you next time.